Paying off your house early could be the most expensive financial mistake you ever make. Not renting, not debt, paying it off early. If you have a mortgage right now, there is a real chance you're sitting on the cheapest loan you will ever get in your life. And every extra dollar you throw at it might be quietly working against you. By the end of this video, you will know exactly why the math flips the script you were taught, and what the smarter move actually looks like for someone in your exact position. Stick with me, because this one changes how you think about every dollar in your budget. You have heard it since you were a kid. Debt is bad. Being debt-free is the goal. Your parents probably said it. Your grandparents definitely said it. Burn the mortgage. Own the house outright. That is what it means to finally make it. There is a reason that feeling runs so deep. For most of American history, a paid-off house was the one thing nobody could take from you. Job loss, recession, medical bill, it did not matter. If the house was yours, you had a floor under your feet. That instinct is not stupid. It is survival wisdom passed down from people who lived through real scarcity. So if you feel that pull toward writing one giant check and being done with the bank forever, that feeling is valid. It is not about being bad with money. It is about wanting peace. The image is powerful. No more payment. No more bank owning a piece of your walls. You picture the day you make that last payment, and the house is finally, completely yours. That feeling is real. But here is the uncomfortable part. Feeling free and being financially better off are not always the same thing. Sometimes the thing that feels the safest is actually the thing quietly costing you the most. And in 2026, that gap has never been wider. Here is the number that changes everything. As of July 2026, the average interest rate on mortgages already sitting on the books across America is around 4.4%. That is not a typo, and it is not old data. That is where most current mortgage holders actually sit today. Meanwhile, a brand new 30-year mortgage right now runs close to 6.5%, according to Freddie Mac's weekly survey. So if you locked in your rate a few years ago, you are already sitting on a loan that is cheaper than what anyone can get today. Roughly 8 out of every 10 homeowners with a mortgage right now have a rate below 6%. Some of them are sitting on rates near 3% from the pandemic years, according to mortgage industry data tracking outstanding loans. Think about what that actually means. The bank is lending you money at 4% or less while inflation and the broader economy move around you. That is not expensive debt. That is some of the cheapest money you will ever be able to borrow in your entire life. Now compare that to what your money could be doing somewhere else. The S&P 500 has averaged roughly 10.4% a year since 1957, dividends included. Not every single year looks like that. Some years are down big, some years are up huge. But averaged over decades, that is the number. So picture two paths with the exact same extra $500 a month. Path 1, you send it straight to your mortgage principal. Path 2, you invest it instead, while making your normal mortgage payment on schedule. If your mortgage rate is 4% and your investment grows at even a conservative 7% average, the math is not close. Over 20 years, that gap compounds into tens of thousands of dollars in the investor's favor, sometimes far more depending on the market's actual path. This is called the interest rate arbitrage. Borrow low, invest higher, pocket the difference. It sounds like a Wall Street trick. It is actually just basic arithmetic that banks use against you every single day, except now you are using it for yourself. Here is a second piece most people never think about. Inflation is quietly your ally on a fixed-rate mortgage. Your mortgage payment is frozen. It does not go up with inflation, but your paycheck usually does, at least over time. So the same monthly payment that felt heavy 5 years ago feels lighter today, because you are paying it back with dollars that are worth less than the dollars you originally borrowed. Paying it off early erases that advantage. You are handing over strong, valuable dollars today to erase a debt that inflation is already shrinking for you for free. Now let us talk liquidity, because this is where a lot of people get burned without realizing it. Money sitting inside your house is not money you can spend. You cannot use home equity to pay for a surprise medical bill or cover 3 months of lost income. To get that money back out, you need to sell the house or take out a new loan, usually a home equity line, often at a rate higher than your original mortgage. Meanwhile, money sitting in an index fund or even a high-yield savings account can be accessed in a day or two. Right now, top high-yield savings accounts are paying around 4% annual yield, according to Bankrate and Forbes rate tracking, as of mid-July 2026. That is money working for you and staying flexible at the same time. Money trapped in extra mortgage payments does neither. Here is the average American's real situation right now. The average mortgage balance nationally sits around $264,000, according to Experian's 2026 data. The typical monthly mortgage payment nationally is a little over $2,100, per Mortgage Bankers Association figures from earlier this year. If that is you, and your rate is anywhere near the national average for existing loans, throwing extra thousands at the principal is not making you safer. It is making you less liquid, less flexible, and quietly poorer over the long run compared to the alternative. There's one more layer people forget. Opportunity cost is not just about missed investment growth. It is about what else that money could have done. Paid down higher interest debt, built an emergency fund, funded a retirement account with tax advantages attached. Every dollar sent early to a 4% mortgage is a dollar that did not go toward something that might have paid you back far more. So the emotional pull to be debt-free is real. But the math says the debt you are rushing to erase might be the cheapest, least urgent debt you have. Now, before you write this off as one-sided, let us steelman the other side properly, because it deserves that. If your mortgage rate is high, say 7% or more, this entire calculation changes. Some buyers who financed in 2023 or 2024 locked in rates well above 7%, and for them, paying down that balance is a genuinely strong, guaranteed return. A guaranteed 7% return by paying off debt can beat an uncertain stock market average, especially if you are close to retirement and cannot afford a bad 5-year stretch. Sequence of returns matters. A market crash right before you retire hits very differently than one when you are 35 with decades to recover. If you are the kind of person who genuinely cannot sleep with any debt hanging over you, that stress has a real cost too. Financial peace is not nothing. If chasing the higher expected return keeps you anxious every single day, the math on paper does not capture your actual quality of life. There is also the scenario where you have no other debt, a full emergency fund. You are already maxing out retirement accounts, and the extra money would otherwise just sit idle. In that specific case, paying down the mortgage is not a bad move. It is simply a lower priority move than people assume. And if your job security feels shaky or your industry is going through layoffs, carrying a smaller mortgage does lower your monthly obligations if income disappears. So this is not never pay extra on your mortgage. It is know your actual rate, know your actual alternatives, and stop assuming debt-free always means better off. The honest verdict, at a national average rate near 4 to 5%, for most people the math favors investing the extra dollars first. At 7% or higher, or if stability matters more to you than optimization, paying down early can be the right call for your life. Notice neither path is about being irresponsible. Both are about knowing which number you are actually working with. Here is the real principle underneath all of this. Debt-free was never the actual goal. Financially secure was always the goal. Somewhere along the way, those two got treated as the same thing, and they are not. A person with a 4% mortgage and a growing investment portfolio is often in a stronger position than a person with a paid-off house and nothing else saved. One of them has a roof. The other has a roof and options. You were taught to fear the bank, but the bank is not the enemy when it is lending you money cheaper than you can grow it elsewhere. The real risk was never carrying a mortgage. The real risk was never learning to ask what your money is actually costing you and what it could be earning instead. So before you send that extra check to your mortgage servicer, pull up your actual rate. That single number tells you almost everything you need to know. Real numbers change decisions. No noise. Just the math, laid out plainly, so you can choose with your eyes open instead of on autopilot. This channel exists for people who want to stop guessing with their money and start knowing. If that is you, subscribe, because the next person who understands this is going to be you.